My name is Gary Dean, and I am co-founder of sentimenttiming.com. My partner is Woody Dorsey, and Woody's been in the business for over 40 years. He was in the USA Today. He was labeled a stock shrink, and he's worked with some of the largest financial institutions in the world, and he actually still does that with his enterprise product. And I was a financial advisor at JB Hanauer, and that's where I first learned about Woody Dorsey, and I was just absolutely amazed about how he was able to predict when the markets were going to reverse. And it was I was just flabbergasted at how it was months in advance that he was saying, look for the rally to end here, look for the the drop to end on this particular date. So from that, I actually bought his book and read it, and I had contacted him because I knew that he only worked with really institutions, and I had asked him if he would be interested in getting involved in the retail end of things, and that's how we started Sentiment Timing. And we're a little bit different than most newsletters, as we don't give specific trade alerts or anything like that. What we really try to do is help traders control their emotions, because emotions are probably their worst enemy of any trader. When you make a trade on an emotional status, when you're turning around thinking that the market's never going to go up and you're long, you end up selling right at the bottom. And if you're short and the market's going up, you listen to that little guy in your head and you end up selling at the exact or covering at the top. And this happens all the time. And what we do, it's human beings in the markets are irrational, and there's always going to be an irrational element at work, and that's what creates the market opportunities. And what we do with this is Woody Dorsey has a proprietary database of sentiment. So he's one of the pioneers of investor sentiment, and he has it's much different than the other sentiment say data that's out there. He's been collecting his sources for over 40 years. And the thing is that nobody's going to be 100% correct, but what we can do, you can predict the markets in the short term. So anybody that looks at the long-term end of things and says, we're going to start a bear market, or who cares? If you can turn around and make money on these big swings that's taking place, you don't really have to worry about the big picture, because the dynamics are always changing, whether it be the Federal Reserve, whether it be regulations, or whatever's going on. So being able to see out a month or two in advance, that's really all you need to do. And it's a way that we really do help our members control their emotions, because they're able to know in advance what to expect. So we let them know, is it safe to be buying? Should you be shorting, or just stay neutral? Because sometimes the markets are going to get choppy. They're going to do things that we didn't really expect them to do. And like I said, we're not going to be 100% right all the time, but when we're not right, if we're looking for some type of top and it doesn't come on a specific turn date, it doesn't mean that it's okay to start buying then if we're looking short, because most of the time when we are looking for a reversal to the downside or to the upside, sentiment is going to be at an extreme. And it's one of the things that if let's just say we were looking for a top and it didn't hit on that specific date, usually it's the market's towards the end of the run, and if it goes up higher, it's not going to go up by that much, and we still get that big move to the downside. So one of the things we do is we do time. The three say market matrix that we do is time, sentiment, and price. So time is when to expect the reversal in trend. And Woody, that's one of the things that, like I've said, when I was a financial advisor, I was just absolutely amazed at how he can predict when these, the markets were going to reverse. And these cycles repeat over and over and over. And he's been studying the markets for, close to 40 years. And when he has these, when these turn dates come, you have to pay attention to them, because you get big moves. We're not looking for just, the S&P doing 10 or 15 points to the downside. When we get these trend reversals, they're anywhere from 75 to 300 points. So it gives you that time period on what to be doing with your portfolio. If you're expecting a low, start buying the dip, even if it comes down, because what's going to happen is sentiment is going to be getting extremely bearish, and everybody gets bearish at the wrong times and they get bullish at the wrong times. So you take advantage of that, and those are the market opportunities. So from that, what we actually do is take price, and that's what I do. We look for technical divergences. We look for support and resistance. So when we have the three elements in place where we're expecting a low or a high from the time, we then have sentiment that is letting us know if that time period is going to be correct for the reversal. Because like I said, extreme bullish readings are found at highs and extreme bearish readings are found at lows. It's just the way that these cycles work. So we then look at the price to start looking for the actual reversal. So what is sentiment? Sentiment is basically how investors feel about the stock market. Now, a lot of people out there will say that it's a true contrarian indicator, meaning that if everybody's bullish, the markets are going to go down, and if everybody's bearish, the markets are going to go up. That is true, but to an extent. It has to be interpreted, and that's really what Woody does, because there's different patterns for tops and bottoms. And if you're just going to take an extreme bullish reading, the first one, you're going to get absolutely crushed, because the first one is usually it's confirming a new uptrend. And then from there, when you start seeing the 10-day moving average on sentiment starting to move up, and you start to see a series of extreme bullish sentiment, that's when you start looking for a top, and especially if there's an expected turn date. So most technical indicators are derived by price. Sentiment is it's made up of human emotions about the market, and extreme sentiment, like I said, does not always mean that it's a market top or a market. If it's low sentiment, it doesn't mean that there's that we're going to get a reversal right away. You have to track both intermediate term sentiment and short term sentiment, because that's what's going to it's going to offer you a clear view of when price reversals may take place. So I have two screens going on here. Hang on one second. Okay, so sentiment is the missing link, and what I mean by that is not a lot of people follow sentiment, not a lot of people understand it. There's a lot of different sites out there that have sentiment readings, but the thing is, if you're not getting the same people that are participating in the polling, you're not going to get a true, accurate measure of how investors feel. So, for example, you may turn around and instead of going to people that are logging onto a website and saying, "Oh, I'm bullish on the market, I'm bearish," what a better way may be is turn around and you get 25 different financial advisors and say, how are your clients feeling? And if they come in and say that they're bearish because they think the market's going down, that's a better view of true sentiment. And like I said, Woody's been studying this for over 40 years, and it's a component of the market, and it can't be confused with other sentiment data, because like I said, you have to be polling the same way to be able to come up with specific sentiment readings. And it's not a system, but it's a powerful diagnostic tool, which many traders really don't understand at all. So the sentiment data is collected. This is just kind of an overview of how things work, where you have our sentiment charts right here. You have the polling part that then goes to our to the different ends of it that filters out into thousands of sentiment readings, and that's how we get that's how Woody gets his numbers on this, and this is what we show our members on a weekly basis. And if you notice, well, hang on, I'll show you on a different chart because it's better. So if you notice, you only see high sentiment numbers and you only see low sentiment numbers, because all the rest is just noise. If there's a sentiment number that's at 26, what does that mean? It doesn't mean anything. So really the only thing that you want to be paying attention to is when you get extreme sentiment numbers. So say over 90% or under 20%. And that's really the way that you want to do it. But this is what I was talking about before, where tops are different than bottoms, and you can see this series of bullish sentiment readings. This is the 10-day moving average on it, and you can see once we got to a peak, that's when this is when you want to start looking on the short side. You don't want to be looking on the short side on the first a bullish sentiment reading, because you would have been short this entire time period. So it's it has to be, you have to look at it and you have to know what it means. And you know, like I said, Woody's a pioneer with investor sentiment, and you know, and how to diagnose what that actually means. So this is an intermediate term sentiment chart that we put out every week too, and it's a 10-day moving average, and you can see usually when everybody's bearish on the markets here, that's when you want to be buying. So everybody is capitulating and selling, and you want to be buying because that's when really we're going to be looking at some type of low. And when it's at the extremes, that's when you want to start looking for being, say, cautious on your with your long positions and putting stops. But really the big thing is knowing when the you know, these markets are going to reverse, and that's really the key is having both sentiment as well as these technical turn dates in place. So the timing profiles are these technical turn dates that Woody uses. It's like I said, it's absolutely amazing how he's been able to predict these, and these lines are actual dates that he had predicted in advance on when these big turns were going to take place, and you can see they're just about exactly in the same time period that they were supposed to happen. And I'll actually show you the reports that this put out. But this is why I wanted to kind of let you know who Woody was and how it worked, because this, you know, this is just shown from I haven't even updated this from I think this is from 2016, but 1,400 S&P points has been it's obviously that's just a number, because from the dates from the low and the high, nobody's going to get in at the exact high and nobody's going to get in at the exact low. But as far as just the turn dates, this is how many points that were accumulated. So this is some of the examples that I wanted to show you. And this is an older one. This is going back to September of 2015. And notice the highlighted, I'm not sure if you guys can see my cursor or not, but if you can't, the highlighted part, this report was put out on September 3rd, 2015. And it was a kill zone, and there's a high probability of volatility to take place on September 17th. So again, it was 2 weeks before the actual expected turn date. And if you look at the chart below, this is what happened exactly on the 17th. It was 140 points that happened in a very, very quick manner. So this next one is this took place on August 4th, 2015. And what it's really showing is on August 14th to the 21st, he was looking for a new high to come. And if you look at what took place on August 18th, 2015, we had a massive drop, and this was the kill zone pattern that he was talking about. So I think I just really wanted to show you some of these predictions, because I showed you the chart before, and these are the types of moves that what's coming beforehand, and they're backed up by investor sentiment. So if we're looking for a top to come on September 17th, and what's going to be accompanied by that is extreme bullish sentiment, and it usually happens on a spike, and from there everybody starts buying into it, the shorts cover, and that's when the markets collapse. Now, if you knew ahead of time, you don't worry about it. You take that big spike and use it to short, and that's really the way our newsletter works. It doesn't, we don't really tell people exactly where to do it. We just look for patterns to be able to let you know what to expect next, and it's been working out, fantastic. So here's just another one. This is September 3rd sentiment timing report, and again, he was looking for that high around 917. It was a black hole. This was what took place on the black hole. We had a massive drop, and that was on the 3rd to the 17th, and that was the exact date. So here is another one that we're looking at, and again, this is a little bit closer to time, but this is August 15th, 2016, and he was looking for we were on the cusp of a black hole environment. Now, this shows you right here where you can see the sentiment on the lows. There was only a couple very low sentiment readings before the market spiked up, but look at all the high bullish sentiment readings. So this was confirming the black hole environment, and this one was a little tricky because it didn't happen on the date that we were. But if you look at this, even though it didn't happen on the exact turn date with the sentiment at these levels, all we did was chop around until we had that really big drop, and that took place. So it even with the turn date not working, you knew not to be buying into the rally that was taking place, because things were not safe with the sentiment at the levels that they were at on it, and that's really the main thing. The main takeaway on that was, don't be buying into this rally. Protect your long positions with stops, or start building a short position. And this one wasn't as let's say big as the other ones, but it was still a decent drop that took place. So let's take a look. Now, this is, again, we're just moving closer to these time periods here, and this was on November 17th. And the reason why I'm showing you this is because we take a big picture, and then from there, as we close in on it, we start closing in on specific time periods to expect the reversal, because there's certain things that take place when a top is going to happen and a low is going to happen. So the 17th, if you remember going back there, that's when everybody was thinking that if Trump got elected, the markets were going to crash. We had some famous people coming on CNBC and saying that they're going to, get out of all their positions if he's elected. And one thing that we were saying in our reports, and this is even before the election, is that there's going to be a post-election rally. So on the 17th, what he had said was that there's what is the best way to set up a 20 or 30% market decline? Spike it up to new highs, maybe 2,300, 2,350. And when is the best time for it to take place? A good decline will occur in 2017. So the bigger picture was, don't short this market in November, because we are going to get a big run up, and it was going to last into 2017. And I know a lot of people that did short the market through the entire time, and they were not happy campers, but you knew to expect that this market was going to just kind of continue higher into 2017. So this is December 6, 2016. And now we zoom in a little bit, and there may be a wonderful bubble high near early 2017. He was looking for February. So again, we didn't really have the exact date, but February was a time zone that we were looking for, and things got choppy, but they didn't fall apart yet. And if we take a look at the March 2nd, we got a 99% bullish reading. And the thing is that marked the exact top, and it's just a Microkill Zone that is going to occur in March. And what happens is we got that, and now we have a second kill zone that is going to be approaching, and it's actually within days away. So you got to be careful if you're long, because the top may have already taken place at the March 1st 99% bullish reading. So what I really wanted to show you, though, it started in November 2016. We zoomed in a little bit more on in December to take a stab at it. Was in February, but then in March we knew that this was the time period where we were going to see some type of top, and that's pretty much what we did. And if we just take a look, these are the sentiment readings here. So this was confirming that we were going to get a big drop. And again, it wasn't as big as as we thought, but it was a Microkill Zone. It wasn't one of the major ones, and it produced the really the largest drop we've seen since November. And this is it. The biggest picture, what the institutions do is, when we start getting into the thrill and the euphoria end of things, they start closing their long positions and they start building a short position. They hang on to it until we start getting into the panic and capitulation. They start closing their short position. And once we get into those big depression moves, they're buyers again. And that's really the way the professionals work, is, when we have everybody expecting higher, they're the ones that are, selling their shares, and when everybody's selling their shares, they're the ones buying it. And these these cycles just repeat over and over. And that's why Woody's been so accurate with predicting when to expect these reversals, and having the sentiment to back things up really helps it out. So I like I said, that was the time and the sentiment piece. And the next part of what we do is we incorporate just regular technical analysis into the equation, because we want to know when when things are are the technical divergences, are they backing up the turn? Are we overextended? Are we at resistance or support? So that's where we have the time part of it. Then we have the sentiment, so we know everybody's either bullish or bearish. Now we want to start looking at where to expect the drop. So this is just a chart from last month on it, and you can see we had the 99 bullish sentiment reading at the on the March 1st. We had bearish divergences on the technical indicators. We were very overbought, and all we were really looking for was a break in the trend. And once we got that gap higher, I had actually mentioned it in my morning notes that usually when you get these gap ups to new all-time highs, it's almost 100% a chance that it's going to retrace that entire gap up, and it's worked almost every time. So with that gap up on it, it was a chance to start building a short position, even if it wasn't going to be the top. That you had a really good idea that at a bare minimum, that gap was going to get filled, because whenever they've done that in the past, every time when they gap to new highs, they've come back and actually taken out the lows of that gap. So another thing I follow is we put out just a regular little I call it a color chart. So it just gives you an overview of what's going on with momentum divergences, and that comes out on it. Just makes it a little bit easier to see. But this is institutional buying and selling. So we look for the total money flow and the block trades. And on April 4th, when we had the nice rally going on, if you notice, the institutions were just outright selling the spiders. So that's a clue that you want to start looking for some type of reversal, because you have institutions that were backing it. We knew that we were running into a turn date that should be to the downside. We know that sentiment's been kind of just going back and forth. There really hasn't been that extreme bullish readings or anything like that. But now we have institutions selling, and then on April 5th, when we had that big move, again, they were in and they were selling the rally. So it was one of those things that you just really wanted to, with any kind of strength, just be looking to short it. And if you notice, this was that gap up, and we ran right into a resistance line, and there was a pattern that was on the S&P futures that I pointed out. I don't think I have it on here, but it's a bearish wedge, and really the target on it was going all the way back down to the 23.45. Now, I didn't expect the 23.45 to get hit yesterday, but it actually did from the high on it. But this is what I'm really showing you on this, is that this is the trend line right now. So the bulls made it, they tried to gap over it, they ran right into it, and from there we saw the massive sell-off. Now, what I do with I look at, like I said, both the technicals, the divergences, but I also look at patterns. And what we're looking at on here is that you have to have an alternate count, because like I said, no one's going to be 100% right. The dynamics are always changing with the market. So you have, until something is completely washed out, that pattern is not in play, you have to keep an alternate count. So I've had this on my charts for quite some time now. And my preferred count is that we made a wave A, we came up, made a wave B, and then we made a wave C of a larger, say, move there. So then what we were anticipating, because Woody had said that we were looking for strength going into last week, and from there we got a nice move to the upside, and the gap up was the wave B. And now we're going to be making a wave C that's going to be coming up. It should take out these lows, and the initial targets that I'm looking at is the 2300 all the way down to the 2275 level. So we were anticipating that this was the time period for the reversal to the downside. We had a pattern in play, but sentiment really wasn't that important, because we weren't getting extreme bullish or bearish readings. So it's the patterns in play. We're looking for this market that used any kind of strength or rallies to build a short position. And really the way that it's going to it's going to be eliminated is if you see a move on the S&P that takes out the 2383, because that was the last previous sentiment high, and it's also would be breaking resistance. So from that, I would then anticipate that the alternate wave 5 up is in play. But right now, I still think there's more room to the downside. We're anticipating that the turn down was going to be taking place after the end of month rally, and this is pretty much what has happened. So what we, just to go back to the whole thing, like I said, we're not a trading service. We're not going to turn around and tell you, buy here, sell there. We give you a roadmap, and from that, you're able to position your portfolios the way that you have to be looking. So if there's a reversal date that's looking down, we have patterns that are looking down. You don't want to be buying and listen to the your CNBCs and the cheerleaders saying that we're heading to new highs and stuff like that. You want to just take that out of the equation, look at what's playing out, and build your, even if you don't short the market, if we're heading up, what you do is just put stops on your longs, or you just wait for that dip to finish and you start buying at the lows. But we really want, our goal is to help traders control their emotions, because it really is the biggest obstacle for just about everybody, even professionals. But you just, when your emotions start taking control of your trades, you make bad decisions, and it's going to be 100% of the time. If you make an emotional trade, it's gonna be the exact wrong trade you should be making. So knowing what is going to be taking place in the next 2 weeks to 2 months, sometimes you're able to ride the big swings, and then when we're approaching expected turns, you just start positioning your portfolio with stops, or letting things ride. But you don't want to be buying into it and adding new long positions if we're supposed to be looking for some type of reversal. So that's pretty much what we do with everything. And like I said, the sentiment part, adding with just regular technical timing indicators, and then using price to determine where, it's worked fantastic. And it's why, you know, some of the largest institutions in the world have depended on Woody's his premium, not his premium, his enterprise service, just to figure out what they should be doing with their money. Should they be investing? Should they be shorting? And we've moved that to a, you know, to a retail end of things where it's not as elaborate as that, but you get the, you know, the same person that's pioneered sentiment and you know, behavioral trading, telling you what you should, you know, what you should be looking for, whether it be a top or a bottom. And one thing that I've been really impressed with Woody is that, you know, if we're expecting something and it doesn't happen and something else happens, he's the first one to say, you know, all right, this was wrong, it's going higher into this state. He's not one that will press the direction that he was originally looking. It's very quick. There's stops that are in place. So one thing that like I said, we don't give actual, you know, trading okay, buy here, sell there. But what we would do is, you know, everyone knew they should be looking for a short side trade. So now what we do is, we don't know where any of our members got in. We don't know what instruments they're trading, but we now let them know if the S&P, you know, goes above 2383, that should be your stop on the short side, and something else is going on. So you know that if that happens, that, you know, something else is taking place, and you don't want to be shorting the market. But right now we haven't had that. We've had a couple attempts at the 2383. They failed, and right now the roadmap that we have in place looks to be playing out. And you know, I was expecting this bounce today just because of the massive sell-off. I thought the bulls are going to come back and fight, but I've been saying, you know, you want to take this strength, use it to you know, to build more of a short position and just let things ride. So I guess if you guys have any questions for me, but one thing that I'll just show you here is we're running a special right now. It's $74.99 for the first month of our service. We typically charge $149.99 per month. So it's for the first 30 days. You get to check us out, see how everything is. Just use the coupon code half off. And like I said, it's if you really want to start taking control of your emotions and you know, being able to anticipate when to expect reversals in the market by one of the best market timers in the world, I would definitely suggest that you check it out, because it's a fantastic newsletter, and like I said, I'm co-author with it, and I use it. I read what Woody's saying just to position my own trades, and it's worked out really well. So so does anybody, I guess I'm just going to open the floor up, Renee, if there's any questions. I don't know if I can't really see it here. Renee, do you see any questions? Or
I do not see any, but if you go to where it says questions and hit the little arrow in the right corner, it'll pop out the
okay.
you'll be able to see it more.
I don't, it's what it is I see it's like a little box. Okay. All right, so I guess that's if there's no questions, I told you I wasn't going to take up the full 45 minutes on it, but hopefully this was helpful with you know, just learning really how to control your emotions. And the main thing is just don't listen to the TV or that kind of stuff. They'll get you on the wrong side 99% of the time. So